Hi everyone, my name is Wahyu Rohman Aritama. I'm a student of IPMI class EMBA September 2024. Right now, I will talk about mind mapping of corporate finance by Professor Roy Sembel. This is my framework of mind mapping corporate finance. Let's start. First, we have into financial management. This is the framework. The first we have objective. This is the quote from our professor. Optimal orchestration of internal and external financial resources toward significant and sustainable value creation. And then now move to goal of financial management. This is the framework. Basic objective. This is a profit maximization and wealth maximization. And then operational objective, timely availability of requisite finance, most effective utilization of finance, safety of investment, growth of the enterprise. And then social objective, timely payment of interest, payment of reasonable dividends, timely payment of wages, fair settlement with suppliers, timely payment of tax, maintaining relations with financiers. And the last research objective, this is researching into new and better resources of finance. Let's move to what to manage. Capital structure, and then working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. Now, corporation financial market. The first is principal agent problem. This is a conflict of interest that occurs when the one party, the principal, as another party or the agent act on their behalf. This is some solution to principal agent problem. First, make managers' compensation reflect share price, stock option, fire managers who do not perform well, take over, and then GCG. This is good corporate governance principle. First, transparency, accountability, responsibility, independency, and then fairness. Now move to 4 cornerstones of corporate finance. Core of value principle. Value is driven by returns on capital and growth and cash flow. Expectation threshold principle. This is the more investor expect of your share price, the better you must perform to keep up. And then conservation of value. This is you can create value by urging claims on cash flow. And then the last, best owner principle. A business of value depends upon its owner capabilities. Now, let's move to time value of money. This is application of time value of money. First, mortgage or KPR and car loan payments, life insurance, personal financial planning, time deposit, contract value, damage in court case, investment value, capital budgeting, and company value. And then we learn about the rule of 72. The rule is how long does it take to double the money. Now move to capital budgeting. This is the capital budgeting concept. First, estimate expected future cash flow. Evaluate the project based on capital budgeting evaluation criteria. decide whether or which project is good or bad. Two more projects can be mutually exclusive, may choose only one, or independent, may choose all good projects. This is the framework. First, we have cash flow. This is initial outlay, operating cash flow, and then terminal cash flow. And capital budgeting method. We have payback period. This is how many years does it take to cover the initial investment. And then NPV, net present value, and then profitability index, and then IRR, international rate of return. Now move to analysis of securities. This is the framework. You can see first we have ratio analysis. This is profitability, liquidity, activity, leverage, and then market ratio. And then this is healthy or not healthy. We have a natural level, quality of number, historical trend, industry benchmark, and then the composition. Now move to portfolio investment. This is the important point about portfolio theory. First, potential or future return, actual return, and then required return. And then the second is ex ante or profitability weighted versus ex post or simple historical average measurements. And then the third, return versus risk. And then four, total risk, systematic risk, and unsystematic risk. And then five, we have correlation and diversification. And then the six, efficient frontier portfolio. And then the seven, portfolio theory or KAPM, capital assets pricing model. Now move to capital structure. This is capital structure theory. A benefit of debt financing is that interest is tax deductible, whereas payments to equity providers are not, and firms must trade off this benefit against the increased financial risk associated with higher debt level. This is a factor that determine optimal capital structure. First, tax benefit. To make tax benefit, it must profitability higher, interest rate lower, and then tax rate higher. It means higher debt ratio. And then expected cost of financial distress. To make this, we have volatility of cash flow higher, fixed asset lower, and then size smaller. It means lower debt ratio. Now we move to corporate structuring. This is the framework. We have 8. First, capital structure. This is there is a lower debt to equity ratio, and then working capital management, and then asset structure, revenue management, cost management, cash flow management, and then growth management. Then the last, risk management. This is some trick to surviving and transforming business. Stop bleeding, financial restructuring, temporary pivoting, strategic realigning, redefining core business, and then new ways of doing business. Now move to fraud risk management. In this fraud risk management, we have 3. First, corruption. This is the framework. We have conflict of interest, bribery, illegal gratuities, and then economic extortion. And then asset misappropriation. We have 2, cash and inventory and all other assets, and then fraudulent statement, we have financial and non-financial. This is the reason of occupational fraud. First, huge personal debt or losses. 2, lifestyle beyond income capacity. And then 3, over speculation in get rich quick scheme. 4, gambling. 5, perceived unfair treatment by company. Pressure from family or system group. Alcohol or drug addiction. And then 8, love affair within the same office. This is the red flag of fraud. First, never take vacation. 2, if absent from office, still do his or her work by phone. 3, one employee covers the whole process. 4, frequent loss or missing document. Too many external guests, conflict of interest, often borrow money from colleagues, look very busy but low productivity. This is some tips to fraud prevention. First, build employee ethics, and then write SOP that have to be followed if fraud event is suspected or discovered or identified. And then the 3, train employee to increase alertness for fraud and how to prevent fraud, including financial control procedure, IT security, and then 5, protective security, include hardware and software, and then 5, create whistleblower mechanism. That's it. This is my main mapping of corporate finance. Thanks for watching and goodbye.